This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, you'll be very pleased to hear that so far as this session is concerned, there's nothing new to be learnt in terms of capital allowances. We've done it all. What we do need to do is to bring it all together, looking at a full pro forma computation as could be required of you in your exam. What we're looking at now on your screen is the basic format and structure of how you construct the capital allowances computation. Before we go through that, and I'll show you the pro forma indeed on the next page if you haven't already looked at that. Before we do that, what we've got to remember is what we've been doing with each of the questions so far. That as we read the question, we don't just read it in one eye, out the other. It's not a particularly fascinating read. What we do is, knowing that we have to prepare the capital allowances computation, we're looking for any tax written down values brought forward, and whether they be on a pool, be it main or special rate, or indeed on a non-pool asset. Non-pool assets, the most likely, of course, an asset with private use by the proprietor, and the asset most likely there, as again well we know, is a car. Other than that, less likely, but a short life asset. So we'll pick up the tax written down values brought forward. What we then do on the question page, looking at the list of additions, we go through that list, allocating, noting on the question page next to it what allowance would be available and any other issues that may be relevant to us. So, for example, when we see a normal item of plant or machinery being purchased, we put next to that, and what we've done, AIA main. We know it's AIA available, and if we go over the limit of 200,000, then any residue would go into the main pool. If we saw an integral feature or thermal insulation, to name but two, then we would know that that is again AIA, but it's special rate pool. We'd also know that if we had a mix of those two, and the combined main pool and special rate pool expenditure took us over that limit of 200,000, that we would firstly allocate the AIA to the special rate pool expenditure. On that list of additions, as well as such plant and machinery, we're likely to see cars. So far as cars are concerned, what are we interested in? First of all, the CO2 emissions. That will determine whether we're talking about 100% first year allowance or an 18% or 8% writing down allowance. And as we mentioned in terms of the possible tax written down values brought forward at the start of the period, what we're also looking for is any of those cars that have been purchased during the period, are they actually used privately to any degree by the proprietor? Remember, we're only concerned with proprietors, the owner's private use. We're not concerned with employee private use. Having allocated and noted on each of those additions, therefore, the particular allowance that is relevant to it, we may have disposals. There, we know that we look for the sales proceeds, but up to a maximum of original cost. Any assets sold from the main pool or the special rate pool will simply reduce the value of that pool. Prior then to computing, we'll presume a writing down allowance on said pool. If a non-pool asset is sold off during the period, then it finishes. That column finishes in this period. It will not go on. And of course, how do we finish off that column? Dealing with that non-pool asset, we compute a balancing adjustment. A balancing adjustment that will be either a balancing charge or a balancing allowance. How do we know which it is? Well, we compare the proceeds with the tax written down value. If those proceeds are less than the tax written down value, it's a balancing allowance. What does that do? It just adds in to the other capital allowances of the period. If, however, the proceeds should exceed that tax written down value, then we're looking at a balancing charge. What does that do? Well, it's just the reverse of the allowance. That is a bracketed figure in your allowances column, and it will serve to reduce the overall capital allowances of the period. So, most important to begin with, before you put pen to paper, if it is indeed pen to paper, in your answer booklet to prepare this capital allowances computation, you need to have used the question page, knowing what therefore each of those purchases and disposals will mean. Once done, how do we then construct the computation? Right, look at the list now. Now, I know it's a list of many points, but again, we've seen this in practice so many times already, and we'll have one big practice question to finish off in terms of our study of this subject. To begin with, we would of course be listing out any tax written down values given within the question there for any pool or non-pool assets at the beginning of the accounting period, again provided within the question. What we'd also be doing, of course, is to acknowledge, looking at the purchases made during the period, which particular columns, in addition to those we inherit at the start of the period, may we need. If we've set up a main pool with a tax written down value brought forward, but we've got special rate pool expenditure incurred that requires us to have a special rate pool, then we'll set that up as one of our columns. So get those columns set up. Far right-hand column, as we know, the allowances. The inside working column headed AIA/FYA, or just a little pound sign if you prefer there. We've then got our main and special rate pools, supplemented if necessary by any individual non-pool asset columns. So pick up the tax written down values, then we deal with the additions of this period. What do we do first of all? We bring in that expenditure that qualifies for AIA. Remembering that if we are talking about total expenditure in excess of the £200,000 limit, again 200,000, I am presuming a 12-month accounting period there. If we go above that, then of course we allocate the AIA firstly to special rate pool expenditure and then to main pool expenditure. If of course we've got any residue then left over of either of those pools, then it goes into the pool figure, the pool column on your computation. Having dealt with the expenditure eligible for AIA and transferred any residue into the relevant pool, probably main, but possibly both special rate and main pool, we then add to relevant pool the cost of any cars qualifying for WDA. So remember the additions for AIA, firstly special rate pool, then main pool, followed then by additions for WDA, by which we mean cars other than low emission. Now, as regards these cars, of course, qualifying for WDA, we look at the CO2 emissions, and those CO2 emissions will then dictate, given that it's not low emission, whether we go to main pool, whether we go to special rate pool, or indeed, are we dealing with a non-pool asset and having its own column because it will have and does have private use by the proprietor. Having dealt with all those acquisitions, it's then time to deduct the sales proceeds, as we have just reminded you, to a maximum of original cost for the assets sold during the accounting period. And we take those away from the relevant pool balance. If we've got a non-pool asset that has been sold, deduct the proceeds, again, same basis, maximum of original cost there, from the tax written down value of that non-pool asset. That, of course, will then give rise to a balancing adjustment, be it balancing allowance, be it balancing charge. Once we have now the residues on the pool, and if we still own a non-pool asset upon it, then we compute the available writing down allowances on the tax written down values we've now established. Main pool, 18%, special rate pool, 8%, non-pool asset, again, probably a car if it's private use by the proprietor, then it's down to the CO2 emissions to again determine, is it 18%, is it 8%? If that figure, of course, is on a private use asset, a private use by the proprietor asset, then having computed the relevant 18% or 8%, what do we then need to do? We need to restrict. We need to restrict, of course, to the business use proportion. The same would hold true if we had just computed a balancing adjustment because we had sold off such an asset during the period. We restrict where we've got a business stroke private use asset, we restrict to the business use proportion. It is for that reason that at the top of any such non-pool asset column for an asset with private use by proprietor, what do we write in? We write in the proportion, use the percentage of business use. And we then restrict our claims to that figure. Once done, there is only one other place to go. That is purely if you happen to have bought low emission cars during the period, which then will give rise to a 100% first year allowance. Add up your allowances available column, get your total and deduct it then, if you are so required to do, from your adjusted trading profit. That gives you the tax adjusted trading profit, and it is that figure that will then be entered onto the relevant income tax computation for the tax year in which that tax adjusted trading profit will be assessed. And how we relate those tax adjusted trading profits of accounting periods to our tax years is something we look at in our next chapter together, chapter 6, where we see the basis of assessment that applies, one that you know about, one that, and I'd ask you to go back and have a look at this before we look at our next chapter together. Back in chapter 2, when looking at the pro forma income tax computation, we made reference there to the fact that any trading profit of the self-employed would be assessed using a current year basis. Go back and remind yourself what that is before the next session on our next chapter, chapter 6, please. Okay. Let's therefore now have a little look at how that structure, that order of doing things manifests itself in terms of the pro forma computation, which if you haven't already looked at it, you'll find over the page. Again, across the top, we're going to put in the columns that we require. The only addition there, as I say to you, is if you wish, you can write in AIA, and if it's relevant, FYA, above that little working column there. We'll then need, as relevant, probably always going to have a main pool, may have a special rate pool, probably won't have a short life asset, probably will have a business stroke private use asset there. And of course, always the allowances column required. From your reading of the question, you would know what columns to set up on this computation prior to actually starting this answer off. There's your written down values brought forward, given to you within the question. Additions qualifying for AIA, firstly dealing with those that are special rate pool, before then dealing with those that are main pool expenditure. If the special rate pool amount of expenditure during the period, if that's more than £200,000 based on our 12-month period here, then we put the 200,000 into the allowances column and any residue into the special rate pool. If the expenditure level was less than 200,000, then that would simply go into the allowances and there'd be nothing to go there into that pool. It would also mean that some AIA would then be left over and available to go against this main pool expenditure here. Now, if of course the main pool expenditure took you over the remaining balance of your £200,000 limit, then you put your allowances in and your residue into your main pool. Once done, other additions. These are the other additions that will rank for writing down allowance, by which we mean cars. Cars, of course, with emissions above 75 grams per kilometre. As well we know, if we're talking about low emission cars, they're the very last item to include upon this computation and where we claim our FYA. And we'll see that at the bottom of the computation. Those with emissions, of course, between 76 and 130 grams per kilometre, into the main pool they go. Any with emissions above that, special rate pool. Or, of course, if any cars during the period have been purchased for and have private use by the proprietor, then we'll have set up the business stroke private use asset column ready to take that expenditure. So we would go into your non-pool column. Once those have been included, then it's time for disposals. As we know, proceeds to a maximum of original cost. Take that out. On the pools, it's writing down allowance time. 18% on the main pool. 8% on any special rate pool. If you've sold off a non-pool asset during the period, Then a balancing adjustment. I've made the point there about a balancing allowance. Again, if we were talking in terms of the one I've used here is the short life asset, as you can see, then you would hope that if you made the depooling election on the short life asset, that the balancing adjustment that would indeed arise would be, as we see there, the balancing allowance. If, of course, you still own a non-pool asset at the end of the period that has private use by the proprietor, then the writing down allowance, as we see here, will either be 18% or 8%. Again, it's usually a car, so again based on CO2 emissions as regards what the percentage is. We make that claim and then multiply it out by the business use proportion, and only it therefore will be available to you. So you deduct the full allowance, the 8 or 18%, but you get to claim only the business use proportion. Remember to do it that way. Don't just calculate the business use element and deduct that. No, it's a different figure that goes in. Compute and deduct the full allowance, then restrict the claim to the business use proportion. And once you've got that done, well, you may very well be there. But the only other thing that may be required of you is listing out, probably won't be a list, it'll just be a single item, but any low emission car purchased during the period. And if that happened, then as we know, it's 100% first year allowance that will transfer over again into your allowances available column. Add up that column, get your total allowances, and as we said, that then would be deducted if you're required to do so from the adjusted trading profit of the accounting period in deriving the tax adjusted trading profit of that period. A couple of notes there that we've already referenced in terms of the statements I've made. The AIA, as we know, is allocated to assets, first of all, in the special rate, or would be in the special rate pool, before the main pool. And not mentioned at this point, but dealt with earlier in our studies, if the balance on the main or special rate pool goes down below £1,000, then of course, that's based on a 12-month accounting period, then we can make our sort of mop-up claim, the small pool WDA claim. And that therefore will take all of the remaining allowance available to us, rather than continuing with ridiculously small amounts there. Okay, let us therefore go over to the last and major example that we've got to deal with. Now, I will take you through this in terms of the information in the question, but what I want you to do is to work then the solution to it yourself, and obviously review through the answer in the back of the book in the example answers. But let's put into practice what we were talking in terms of but a few moments ago. What I'm going to do, capital allowances for the year ended 31st of March 17, assuming here that no short life asset election is to be made in respect of the computer equipment. Again, with something like computer equipment, that is probably the main asset where you might consider at least the short life asset election. If, of course, you have available AIA, then you wouldn't bother. But again, you have an instruction there. We're not going to go down that road. Right, as we know, Lynn prepares accounts to 31st of March. The opening tax written down values are, on the main pool, £30,000, and on a car, £14,000, and the reason why it is separate and not a part of a main or special rate pool is because it was used by Ling 20% for private use, Ling being the proprietor. We are, of course, concerned about the 120 grams per kilometre because that will indicate the level of writing down allowance that is available to us. And you should know, of course, what that is based on that CO2 emission figure. Following transactions then take place. Okay, what have we therefore now got? Purchased a motor car, emissions 70 grams per kilometre. Right, car, no AIA. Emissions will dictate whether, as here, as I hope you now realise, it'll be 100% first year allowance, or if we've gone above 75 grams per kilometre, then we'd be talking in terms of writing down allowance. We then need to know, is it going to be main pool or special rate pool expenditure. Purchase computer equipment, that is standard AIA and would be main pool expenditure. Purchased a machine, AIA, again, main pool expenditure. Plant, AIA, again, main pool expenditure. Purchased a car, emissions 115 grams per kilometre. Right, that of course is not low emission. So we're talking about writing down allowance and no reference here to any private use by Lynn, by the proprietor there. So in which case, at that level of CO2 emissions, it too will be allocated to the main pool. Then thermal insulation for the business building. Thermal insulation. Well, that, I hope you recall, is eligible for AIA, but it is special rate pool expenditure. Special rate pool. So that means when you come to apply your AIA, the AIA of 200,000 will be applied firstly to the £28,000 expenditure on the thermal insulation, because that would otherwise be special rate pool. Now you've got there three other amounts in relation to the main pool, and if you quickly add those up, you can see that we're going to be over 200,000. What it will mean is you apply AIA firstly to the special rate pool, 28,000. What then is left out of your 200,000? That will go against your main pool expenditure, with the residue unrelieved by AIA going into the main pool, upon which for this and future periods there we'll be claiming our annual writing down allowance. One other point, disposal of the car used privately by Lynn, £8,000. We're disposing of an asset that had private use by the proprietor. What will that therefore give rise to? A balancing adjustment. We know what the tax written down value brought forward was. It was some £14,000. We're selling it for a meagre £8,000. We're selling for less than the tax written down value. That balancing adjustment will therefore be a balancing allowance. 14,000 minus 8,000 is very obviously 6,000. Will you get to claim all of that as a balancing allowance? No, you won't, because it will be restricted to the business use. Again, read the question very carefully and be careful what you write into your answer, because what they gave you in the question was the private use. If it's 20% private, it's 80% business. I've seen many times when students have picked up the percentage but got it the wrong way around, expressing what should have been business use as private use or vice versa. Just make sure you appreciate which percentage, how much is the business use, because that is the claim. We will get 80% as our balancing allowance to be claimed. Now you can see there that we've got a fairly full listing of items that we may possibly have to deal with. We've got expenditure that's eligible for AIA, both special rate, do it first, and main pool expenditure. We've then got a car being purchased that will be allocated to your main pool, and upon which writing down allowance will be available. We do have a disposal, but a disposal of a non-pool asset, giving, as we've just stated, a balancing adjustment here in the form of a balancing allowance. We've also got, right at the very beginning, a first year allowance, a low emission car. So we've got a pretty good set there of the transactions that you might have to deal with in terms of any examination question. Follow the pro forma, do it in the right order, set it up properly, structure it properly. Again, too often here, students try to rush it, don't bother with proper structures, proper formats, and make a mess of it as a result. make sure you get this right. Check through then with the answer, and hopefully you'll find that it and you agree and all is well. Now we will be coming back to capital allowances, as we will be coming back to adjustment of profits, albeit pretty briefly, but when we look at corporate tax. Companies, their main source of profit chargeable to corporation tax will be their tax adjusted trading profit. What will that therefore require you to do in a corporate tax question? Adjust up a statement of profit or loss, albeit there for a company, rather than here the unincorporated trader. The rules are mostly the same. In fact, there's less to be dealt with in terms of corporate tax adjustment of profits. That statement also holds true for capital allowances, where we will discover that when dealing with corporate tax, life is made easier because there's no such thing as private use by the proprietor. There isn't one. So on that basis, anybody in the company is an employee. There's no proprietor private use, and therefore that's one less thing to worry about in a capital allowance computation prepared for a company. So we'll be revisiting these areas. So again, hope you will put this in the back of your head to remember before you start your study of corporate tax, before you go into that first lecture. Have a little look through again the adjustment of profits in Chapter 4, the capital allowances here in Chapter 5, to make sure you're then ready to deal with those issues again when we look at corporation tax. Okay, as mentioned to you, next chapter deals with having got a tax adjusted trading profit, how do we then know how and where to assess that in relation to which income tax computation for which tax year, where will it appear? All of that, the basis of assessment, awaits you in our next chapter, Chapter 6. Again, as ever, I look forward to seeing you then.